My name is Jeff Steiner. I'm a board member of the Toronto Global Forum. It's my pleasure to serve as the Master of Ceremonies for this Executive Club private event. We're going to have two fantastic leaders from Morningstar and from UBS Asset Management in today's session.
Well, thank you. And Suni, thanks for taking the time to have a conversation with me. I think the plan is for us to talk for about 20 minutes, and then Jeff, I think we'll have a couple more questions. So thanks for taking the time.
Pleasure to be here.
I always like to start conversations these days by asking a very simple question, which is, where are you? And what's it been like these last few months? I know that when people ask me, I say, well, 2020 was not in the job description, so I'm curious how it's going on a personal level before we kind of get into the business side of things.
No, like yourself, Kunal, it has been one of the weirdest years we can all remember. I'm actually one of the fortunate ones. I am home. I am normally located in New York City for work, and I commute, quite an extensive commute. I usually spend about 3 hours a day in the car going to and from New York City. So I have recaptured 3 hours of my life, one for sleep, one for family, and one for work. So I'm more productive all around. So I'm really very lucky. We've been here for, 8 months now, and probably looks like another 6 months. So it's going to be a long time.
Yeah. So do you think you're ever going back?
I will go back. I think UBS is going to learn some lessons here and be much more flexible for all our employees going forward. But whether I return to full 5 days a week, 14, 15 hours a day in New York, I certainly hope not. But I think we're all learning some lessons here to be flexible.
Yeah. No, I'm in the office today, and it's nice, but it strikes me whether you're in a big city, Toronto or Chicago or New York, one of the balances and opportunities for all of us, who are part of the communities to figure out a way to keep the cities thriving as well. And that's going to be an important outcome.
We're located in Times Square in New York, and between the office towers of Midtown New York and the tourism, both of which are not there, it really is tough to look at all of the buildings, offices, restaurants, bars, et cetera, that are being shuttered because of COVID. So it really is a very tough time. So I'll get there as soon as they figure out how to get us up the tower in the elevators, and we'll be able to add back to the economy.
Yeah. And what's it like just been, as a leader, what's it been like these last not last few, but the last 6-7 months now? And, what are some important leadership lessons from your perspective that you're going to take away from this period?
It's actually a great question, because I took the role here of president and running the business just about a year ago. So we were just kicking off some changes and some new programs and rallying employees around a more streamlined strategy when COVID hit. And so it's been a double-edged sword, right? We've brought in some new people. That's very difficult to do when you don't see everybody every day, obviously. We've brought in a number of new leaders in asset management, which is a credit to them on how well they have connected with their employees. But I think it has been easier for us in one way, in that we had so much enthusiasm around the changes that were coming. And we walked into tremendous momentum in January and February, and it's carried us for quite a long ways. And so it's been great to see employees maintain that enthusiasm, despite the fact of all the pressures that they're under to work from home. So, maybe unique to us, but management lessons learned. We used to get together once a quarter for the classic town hall. We get together once a week in an all-employee conference call. We've combined that with business updates that we rotate around the businesses. We add that to our macro market outlook call. So every Monday morning, you're getting a full complement of connectivity with the firm in a variety of areas. We've stepped up the frequency of all of the meetings. All our meetings are virtual. We've increased a lot our volunteering, a lot of virtual volunteering opportunities. For those of you that celebrate Halloween, I get a kick out of this one. We're doing blood drives around the globe in honor of Dracula, I suppose. But to drive some connectivity, have a little fun, and at a personal level when we can't do that together. So we've tried a lot of new things, and I hope a lot of these lessons stick with us.
Yeah. I want to know what it was like when the person came to pitch you on that idea about doing a blood drive for Dracula. It must have been kind of fun. So shifting gears a little bit, obviously, amidst all of this, you have clients and investors to serve, you have a business to run, and while much is being written about the fact that the business environment is changing, the reality is if you're an asset manager, the environment was already changing pretty dramatically, and in some ways this maybe accelerates something. So I'm curious if you'll just highlight from your perspective what some of the changes are that you're seeing, and maybe towards the end you could highlight one or two that have been accelerated because of what we've lived through in the past 6-7 months.
Yeah, I think anybody that's watching any of the headlines actually recently, but in general, the trends in asset management, it's a story of fee compression. Headlines talking about passive taking over active and all of the things that brings. Costs are increasing for the industry between regulatory changes, which are really difficult to keep up with. The technology spend, I think, the industry has attempted to be a tech industry for a long time. I think that's not served us well, and we're paying the price of that. Risk management, liquidity, a number of new areas that are being brought to bear on the asset management industry. So all of those things telling a very difficult story for the industry, and hence a lot of the consolidation rumors that are out there, or even in fact some consolidation as we've seen in recent headlines. The good news is the demographics are in our favor. Middle class, pre-COVID, I should caveat that, is growing around the globe. Wealth transfer from generations is a very big deal. Our clients there's a tremendous amount of margin pressure on our clients as well. So we're seeing increased number of outsource opportunities from clients for OCIO. Certainly Morningstar knows that as well, and some of the offerings that you all have. Complexity of markets is only increasing as the sell side banks have to move back. They don't have the balance sheet or the capital to invest. So private credit, private markets, access pre-IPO, all of those things are part of the wealth equation now that asset managers are asked to bring to bear for their clients. And of course, sustainability, which is a driving function that we had been seeing, but certainly one of those things that has accelerated. So on the environmental side, massive, we want a green recovery, all of that effort, focus on stewardship, focus on engagement of companies, focus on transparency in terms of how we're investing our clients' money, how we're getting and ensuring that we are meeting the needs and the objectives that they're setting for their portfolios is a much accelerated trend and will be with us for many years. The interest in private markets I mentioned, but again, an acceleration of things like SPACs. You know, SPACs have been around actually for over 10, maybe 15 years, but only recently are they in the headlines all the time. That speaks to, again, the need for private capital and access that investors want to see. So I think that's a new trend I'd point to. The interest in China. China, we went out probably 3 or 4 years ago suggesting China should be a separate asset class from emerging markets. I think that is common nowadays, but boy, the interest in China, despite the trade issues with the United States and some of the other and the civil rights issues that you see, tremendous demand for access to China, both onshore and offshore. That's accelerated in COVID, driven a lot by their performance and how their markets have done, how they, of course, were the first to be hit by the COVID virus, but have come out of it very, very cleanly and very quickly. So all of those things are trends that we're dealing with, and I think we'll feel for 5, if not 10 years going forward.
And so I heard a number of themes there. You know, one is sort of a continuation of the trends just around pressure on fees, and certainly that seems like it's here to stay. But I also heard a number of things that you highlighted around how the industry can think about creating value for the end client. And it seems to me that the big disconnect when we talk about fees really comes from the reality that I think a lot of clients don't actually understand where the value is created for them. And so how do you think about answering? Yeah, how do you think about answering that? Like, what is when you talk about how you stack up, for example, against a passive product? The argument in the past was, well, active is better, and clearly that has not always proven to be the case. Often not, in fact. Right. And so, like, what is the rebuttal to that today in your mind? There were a number of themes, but how do you think about like showing that value chain to a client?
Yeah, no, that's a great point, and it goes across a lot of different things, and transparency and disclosure is one of them. But so look, we at UBS Asset Management quite proactively, we have both passive and active products. outside of our alternatives book, we're about 50-50, have been 50-50. I expect we'll continue to be 50-50. So I'm not afraid of passive. I think to your point, though, we went through at least a decade, if not longer, of passive indices providing as much value as alpha did, and it wasn't worth the fee. Of course, volatile markets make that story a little different, this year being no exception to that. But we have obligation to bring beta to our clients at a very, very cost-efficient basis, right? For me to charge an active fee for beta outcomes, that's not fair, right? So, and that has been what the industry was doing maybe for many years. So our growth plans, our strategic initiatives around those areas where passive is a very difficult place to be. So sustainability, maybe you're going to see some of the greenwashing arguments there, and maybe we'll get into that. China, any area of emerging markets where you boots on the ground make a difference, and a broad index might carry you there or might get you into real trouble. Access and private markets, by definition, alternatives you find yourself in the fee generating, but always as a proportion. We've also seen a trend to that point. I'll just throw in there that more of our traditional long-only active products are incorporating a performance fee. And we started giving clients that option some years ago, and we're seeing more and more clients take us up on that, because then they know they're only paying if they get the returns that they think they should be generating with us.
That's right. And is it fair to say that those trends that you're highlighting are true of what you see in Canada as well?
Yes, again, the Canadian market is actually quite sophisticated, and there's a lot of interest in alternatives. That could be because of the work in the private sector there, and some of the markets that are strong along the lines of oil and sands and things like that. Also, a tremendous interest in sustainability out of Canada, which is great to see. Again, a interest in diversifying. And I think Canada brings to bear something that I've watched throughout my career. Canada is a very, well, it's a big market to itself, but the access that non-Canadian firms can bringing the globe to Canadian investors has always been welcome in Canada, and that want to reach the globe and diversify specific exposures that you might have just in Canada has always been a trend, and I think a very smart way to manage portfolios in the Canadian market.
Yeah. I'm glad you started to talk about sustainability too, because I got to pander a little bit to our Toronto-based Sustainalytics team. Obviously, ESG is top of mind for investors today. Can you talk about how you think about that becoming part of the conversation and the value chain that you can bring to investors? I mean, we think, just for context, that there's an opportunity to personalize the experience more so than ever before. I wonder if you agree with that thesis, or what your thoughts are more broadly.
Yeah, well, it's a great and very interesting conversation to have. So, just in 3 years, so we're about to celebrate our 25th year of sustainable investing at UBS with our global sustainable equities products. So we've been around for a very long time, and we invested probably extensively maybe 3 or 4 years ago. So seeing this coming. Still, it has astounded me how fast the world has shifted. And the U.S. behind everybody else because of current administration. But having said that, we went from a check the box, and maybe you had 1 or 2 exclusionary funds in your portfolio and everybody said, okay, you were ESG friendly, all the way through, you better be fully integrated. And investors are so much more sophisticated in just 2 years' time. They don't want to know if you're ESG friendly. They want to know how. They want to know what you're doing. They want to see your stewardship record. They want to see transparency around, again, the reporting attached to it. So it's been a massive shift, and one that I think will be here forever. I think sustainability has become core. Even in the United States, I haven't seen an RFP probably in at least 18 months that didn't have it as a primary criteria for even consideration of a mandate, even if that mandate isn't about sustainability. And I think what COVID brings to bear, which will be more challenging, by the way, are the social aspects of that. So we've had governance forever. That is what we're paid for, to think about governance in the data set that we put together when we value a company. And then it was environmental, and with whatever data we can, and again, a leadership role in trying to drive that data. As you know, it's Sustainalytics. That's what they do, and pull all of that information together and drive some consistency so you can compare products and outcomes. But social is a whole nother world, and social is going to be very, very interesting to see how you track it, how you follow up on claims, how people can make promises, and what type time frame is there. We have that with carbon. We have that on the climate side. We are a long way away from that on the social side. So that will be one of the interesting outcomes to watch going forward. So I do agree with your thesis. I think it is integral to everything any investor does. And I think the risks are real on both the transition side as well as the physical side. And as I've been wont to say, any investor who's playing in the markets and isn't thinking about ESG risks really does so at their peril.
Yeah. There's an alpha aspect to it that maybe people should be paying attention to. You touched on the social aspect of it too, and I wanted to just spend a moment on that because I know it's important to you personally as well. And I'm curious, given everything that is being talked about in the U.S. and Canada these days, especially around diversity, equity, and inclusion, how you are thinking about it personally as a leader and how UBS is thinking about it, and perhaps just some tips you'd share with other leaders who are on here in terms of how they might, undertake this journey. I think it's a big and complex undertaking for many, and if you could share some of your own thoughts and how you've been on that journey, I think it'd be helpful.
Yeah, journey is the right word, Kunal. I think that's the right way to do it. I think we all are familiar with and have the standing obligatory councils and training programs and whatnot around gender diversity. I think ethnicity is another ad that has been brought to our attention in a really, really blunt way, and for all the right reasons. So I think the social dynamic that comes with the racial question, particularly in the United States, but also around the globe, has driven an acceleration, a sense of urgency that has not been there in the 35 years I've been in the industry. Again, gender equality, yes, and again, I don't want to downplay it at all, but it's taken us 35 years to get to where we are, and we're not very far, if I may. So it's, I think the sense of urgency is really great to see. I think we've all learned that while many, I will include myself for sure, thought we understood it. Of course, I'm a champion of diversity. I get this. Yeah, no, I had no idea. And one of the things that I'm really proud about being part of UBS is from the beginning, UBS was not defensive, which would have been an easy place to go to. And I think some firms might have been tempted to that route. We shut up and listened. It was very, very uncomfortable to hear some of the things we were hearing, not necessarily about our firm per se, though of course that's part of the discussion, but about society broadly defined and some of the things that are happening today, every day for our employees, for our clients, for their children, et cetera. So it's really been eye-opening for us. And I think it becomes, again, a part of the discussion. You've seen, again, everything from regulators come in and say regarding COVID, thou shalt not pay dividends if you're laying off employees. The fact that most companies in the world have not laid anybody off. So that is putting, again, on the face of it, shareholders second to employees or to communities. That's a very different approach to what we've seen historically and what the ask is of fiduciaries. Now, of course, I do believe that comes back in brand equity and the long-term benefit for the investment that you have. But that's a very, very real shift in how we're supposed to be looking at returns and the outcomes generated by our portfolio. So we absolutely are asking the questions. Industries that had been sacrosanct and you can't, hedge funds don't care about diversity. What do hedge funds know? It might be 10 people in an office in Toronto that are the hedge fund. How diverse can they be? But no, we're demanding that now across the board for the portfolios and the companies that we invest in. So again, I think a real acceleration for that. It's not an easy question to answer, and we're still figuring it out. We have a long way to go. I think, though, it needs to be something that is grassroots as well as top down. And by that, I mean grassroots, every part of your business has to reflect what you're going to do and what your position is going to be around equality. So, where is your social giving going? And is it going to things that are consistent with that view? So if you're giving money to a children's charity, do you have some portion of it at least focused on underserved communities? If you are looking at microfinance, are you doing that in diverse neighborhoods? If you are investing in funds, how many of those funds are minority owned or operated, or funds that are managed by those employees? What does your own employee set look like? So every part of what you do has to reflect this diverse equation. So it comes up from the grassroots. But in my experience, diversity is also, it can be expensive. And when we say I said that wrong. It's expensive in the short term, long-term benefit. So I have to be careful. But when I say it comes from the top, it's not just because it's the tone set by the top. And you know this as a CEO yourself. You can speak about it all you want, but a lot of what's required to really drive sustainable change in the diversity of your employee makeup or your businesses or the vendors with whom you work requires tracking data, requires metrics, requires a consistency of data across all of your portfolio of all your businesses. It requires maybe one single set of appraisal criteria for all of your employees. These are things that actually take investment from a company, and they have to come from the top down. And so if you as a leader and you're all here struggling with this, think about that. Think about all the programs that you have. You don't have to create new ones. Maybe you just switch over or engage or broaden the existing ones that you have to be efficient. But it really does need some data to support that change. Otherwise, you're going to end up with anecdotal reasons. Well, of course, all the women leave. They all want to have babies. Well, maybe. Or as we did in my prior firm, when we did an exit interviews on the 60 high potential women that had left that year, 58 of the 60 went to a competitor. That stat alone was incredibly powerful at driving the change that we wanted to see. So again, but you have to have had done all of the exit interviews and track the data and whatnot. So I digress.
Yeah. No, that's great. I mean, obviously you're giving it a lot of thought, and it's not a easily tackled issue and not a short-term fix either. And I think your comments and your passion for the issue are super clear. I know we're up at 1 o'clock in Toronto, so I am supposed to pass it back to Jeff at this point. But thanks for having this engaging conversation. I think Jeff has a few questions for you as well.
Terrific. Thank you.
Well, thank you both. And I do have some questions, but they are not limited only to Suni. I'm going to ask you, Kunal, where are you right now?
I'm in Chicago.
I assume it's Chicago.
Yes.
It's a fantastic city. I know everyone in America is probably focused on what's going to happen exactly over the next week, which we won't touch upon today too much, but welcome from the United States.
We're right in downtown Chicago, and Cook County City Hall is right here, and so I can see the ballot boxes right outside our offices, actually. So hopefully people are stuffing and getting their votes in. So. Well,
I trust the process is going well. We all look forward to hearing about that a little bit more next week. Kunal, though, before I ask Suni another question, because she may need a bit of a break from your intensive cross-examination, particularly around fees, I wanted maybe you to tell us a little bit more about the Morningstar Inc. and how things have been changing, how it's been growing. I know you guys do obviously the research, you do analysis, you make recommendations, so companies and journalists. But there's also a new or an emerging platform. Technology is a big part of it. You've grown internationally. I know you've been involved personally in the international strategy of Morningstar. Canada is part of that, Morningstar Canada, DBRS. I'm wondering, how have the needs of your customers and how has Morningstar changed to serve customers and users, whether it's asset managers or journalists? What's been changing over the last couple of years? And I'm not talking about COVID, but more about the needs of your clients and how you've changed the organization in the 3 years that you've been CEO.
Yeah, sure. First of all, our true north is empowering investors and their success. And so whatever we do starts with the notion of, can we drive an outcome that the investor can be successful in? And as Suni highlighted, the investor portfolio is changing. When I came to Morningstar 25 years ago, the world was pretty simple. You own stocks, bonds, and cash. And that's what a portfolio looked like. Today, I mean, you can open up a bond portfolio, for example, and you won't find bonds in there because it's a series of sophisticated instruments that are giving you the exposure that you want. And so, we've continued to evolve to ensure that as the investor portfolio changes, we are there with the investor. So whether that has included making an investment such as in DBRS Morningstar and ensuring that we start to increase the amount of fixed income we're covering. Or we own PitchBook, which is a leading provider of data and research in the private markets. We're trying to encapsulate the overall portfolio. And today, the big way that we think about empowering investors is really around personalization and engagement. And so one thing I like to say to my friends in the industry is that all of us probably grew up thinking that everyone is like us and wants to be an investor. And the horrible newsflash is most people outside, the ones we know at work don't want to be investors. Yet they need to have the tools to be financially independent. And so a big part of the way I think about our future in places like Canada and the US is not only to serve the investor, but to think about how you can personalize and engage the investor so that more people want to do it. And our ownership of Sustainalytics and big push into ESG is not just something personally that I'm committed to, which obviously I am, but it's something that I believe has the potential to, positively change the landscape and increase the number of investors, bring more women, younger investors into, relationships with firms like Morningstar, UBS, and the many that you have represented here. So our North is the investor and empowering the investor, and where that goes is where we end up going, and, so be it.
Well, that's terrific to hear. And you had mentioned the innovation economy with PitchBook. Here in Toronto, I oversee the angel investor networks in the province of Ontario.
I hope you have a PitchBook subscription.
Well, exactly my point. And I'll tell you, your PitchBook team is very good at following up to make sure we update our PitchBook profile to make sure it's meeting our needs, et cetera. So you have a great team at PitchBook dealing with that early stage part of the market. So much appreciated. Suni, I wanted to follow up on something you actually plugged a little bit. You said maybe we can deal with it later. And that's this greenwashing. We're hearing so many new phrases. ESG is not that new a phrase, but there was corporate social responsibility, CSR. There's E and S instead of ESG. There's CR, corporate responsibility, which isn't actually the environmental. It's more about, know your client and make sure there's no corruption, et cetera. So greenwashing. Tell us a little bit more what that means, what that context is, and what we as investors and the public should be looking out for.
Well, that's a great question, and I think it is. First of all, I will say I think I'm sure there is lots of greenwashing out there. I think there probably is not as much as the headlines we're seeing recently and forthcoming are as bad as it seems. I think the issue lies in the fact that the definition of ESG, as you say, means different things to different people. And if some people will say that if you've got an ETF and it excludes a certain industry, then that's not really ESG because the rest of your index isn't taking into consideration all those things. That's greenwashing. On the other hand, someone will tell you an ETF that maybe uses that scoring integrated across all of their investments includes carbon heavy companies, oil companies. ExxonMobil was the headline last time, that including them at all is greenwashing. I think this is going to come down to disclosures. This is going to come down to investors really having to do their homework and understand what it is they're buying. So again, there are focused funds that literally have, and Kunal mentioned it, the focus specific, customized to what a client is looking for and a particular objective in what they want to do. And then they're kind of the broader definitions that can be a catch-all, and you need to read exactly what it is that's going into your portfolio before you invest in that particular area. So there's a lot of marketing hype around it. And as I said, though, I think clients have gotten very sophisticated very quickly. And the question is not, okay, Suni, is this an ESG portfolio? It's okay, how, why, how do you know? What does it say? 3 years, what's your horizon? How have you performed, et cetera? So, greenwashing will only be here for a little while and only affect those clients that aren't doing their homework. I hope. Interesting.
And it's good to understand that term and that phenomena a bit better. It's I hear you saying it's only going to be around for a while. So we'll hold you to that and see how things progress. Climate change, the social, the impact investing, all of these things has been a big part of the discussion today during this private session, but also during the general conference. I'm wondering, though, about geography. The challenges for investors in emerging markets, in sub-Saharan Africa and parts of Latin America. Another acronym, of course, is the SDGs, the United Nations Sustainable Development Goals. I'm wondering, a question really for both of you, how do asset managers handle both the need, the opportunity, but the goals of society through the United Nations? For many of them, women's economic empowerment comes to mind. I think it's number 12 or number 4. There's 17 of them. How do investors handle that? And how does Morningstar, secondly, help with the investors to deal with the emerging markets and some of these sustainable development goals?
So maybe I'll start.
Start with you, Suni. Yeah, please.
You've got these are together bands. We have 17 of them, UBS sponsors. I'm wearing 7 of them, each with their own color. I think the holy grail for us as asset managers is, in fact, to have at least one product for each of the 17 SDGs. And one of the things that is challenging to be part of a large company where people expect us to have a view, but also to serve clients where it's up to them. I am not here to impose my values on all of my clients. I have clients that are oil companies. I have clients that are utilities. I have clients that do a lot of things that some others might disagree with. And so our main goal is to raise awareness and educate and certainly manage the risks that are there, but to give the choice to our clients in the different ways that they might want to invest. So we are very much aligned with the SDGs, but as I say, it's a bit of a holy grail. Some of them are very difficult to find products or ways for our clients to execute against those objectives, but that is our plan and our hope to be able to do that. Kunal, I jumped in there.
Yeah, no, I think you covered everything fully. I'll just say from the Morningstar Sustainalytics angle, the important aspect of this is how you can normalize the data so it can be consumed in a way that makes sense, particularly, when you talk about emerging markets. As it is, ESG is an area where even in the developed markets, we're still trying to define exactly what good data looks like. So I think the standards for data that's going to be provided are going to rise in general. And we will get to a place, even in EM, where some of that data will start to get standardized. For example, while most people probably don't think of it that way, already in China, given some of the efforts to control pollution there's a lot of interest on a societal basis on which companies are doing the right thing and how to collect information on that. And so you're seeing naturally, as people get wealthier, they do start thinking about the societies that they're a part of and how they can have an impact. And I think you're seeing that in some of the emerging markets as well. And then there's business opportunities. That's just the bottom line, right? Entrepreneurship stems often from opportunities like that. And I think ESG will be a great opportunity in emerging markets for entrepreneurship.
Oh, thank you. And the broad brushstrokes, climate change is driving these kind of changes, this consciousness, the younger demographic. I'm wondering if you have an observation on, insurance company assets and the way demographics maybe is changing the risk parameters for investment regulators. Taking a different approach to what you can manage on behalf of, let's say, a 65-year-old who might have in the past only had a shorter time frame, but now are living into the 80s and 90s, and how maybe the asset management industry is looking at that broad brushstrokes of demographics rather than environmental and some of the other higher profile changes going on. That one would be for you, Suni.
Okay, no, that's fine. I didn't know if we wanted to go both. So yes, of course, the changing demographics have been coming for some while. Those are also regional, to your earlier point, right? The changing demographic and the rise of the middle class, for example, that we see in China is hugely prevalent. And so we'll have products that are geared toward them offered there that might be different than what we're seeing in the United States, for example, or Japan even, where the demographics are completely different from that side. So yes, so insurance companies, looking for longer assets, which are very difficult to find, by the way, and in a zero interest rate environment, that a bigger trend I think we're seeing versus demographics really on how do you find returns. My parents paid for their 5 children's education by investing in U.S. Treasury bonds at 18%. That's hard to even conceive of in today's market. So how do you find those returns in your investments? Hence the rise of the alternative asset classes, more in real estate, huge demand, particularly from that set, for example, for real estate and sustainability, agriculture. We're looking at a cold storage fund, for example. Some of the things that food security is one of the big SDGs out there. So how do we drive that? So it's really a marriage of some of those demographic needs being driven, as well as putting that overlay of sustainability and trying to use that innovation to come up with something that solves a couple problems at once.
Kunal, did you have something to add?
I didn't. I think the only other thing that I would just add is one of the challenges that we foresee for older demographics is just the fact that interest rates are as low as they are, and that as yet at least the alternatives that are emerging have not fully replaced some of the income needs that people have. And so going to the heart of your question, we've talked a lot about different topics, but I think fixed income is going to be a challenging space, and one globally to pay attention to, especially if you're a retiree, because the returns of the past decade, 2 decades, are unlikely to be repeated, and I think that will pose a significant challenge.
I think that's right. We talked about the 60-40 rule that we've lived with in investment management just isn't going to cut it. If it was 10% historically, it's 2 or 3% now, which would naturally drive people into the equity markets, increase risk. That doesn't work. So that is one of the conundrums that we face. So looking for maybe longer term, less liquid, but still fairly safe and maybe income generating things, again, like real estate where there's tremendous demand.
Well, and I hope in the real estate, the cold storage network that you intend to invest in gets distributed very quickly, because that's where the vaccines are going to have to be stored coming early next year. So Godspeed to you on that. Ladies and gentlemen, we're running out of time. We've had the excellent opportunity to hear from these two fantastic leaders. I wish we had a little bit more time, because that topic that came up at the beginning about fees, we have many people on this video call from all over the world who are involved in financial services, asset managers, customers, suppliers, advisors. We'd love to have a discussion on fees. It sounds like there's more going on than just fee compression. There is some innovation. There is some changes. So we could do a whole session one day just on that. But Suni, Kunal, I just want to thank you on behalf of the total audience and also on behalf of the Toronto Global Forum for being with us and sharing so much. So I would say to everyone a round of applause, but there's only a few people in the room. So I'm going to thank you on their behalf.